Hello from the Dukascopy TV studio in Geneva. We're talking about the low oil price and the perspectives if this is going to stay with Professor Robert Piller. He is professor for commodity trading at the Haute Ecole de Gestion HEG here in Geneva. Welcome, Professor Piller.
Thank you, Daniel. Nice to be here.
So, can you outline the reasons and the dynamics of this current price war in the oil sector, the oil price?
Yes, well, it effectively is a price war, which Saudi Arabia basically declared back in November. There was the OPEC meeting last week. The oil price didn't move very much because more the same, but the meeting in November seemed to herald a fundamental shift in strategy, where rather than protecting the price, Saudi Arabia, and taking OPEC with it, decided to protect market share instead. Really, the main driver has been the emergence of U.S. shale oil production, which has been quite dramatic the last 3 years. If you look at the statistics, 3 years ago, the United States was producing about 5.5 million barrels per day. Then suddenly it jumped 1 million barrels to 6.5 million, then 7.5. Last year it was over 8.5 million. So there's been this tremendous increase of daily production. And the other important dynamic is that it's against the law to export U.S. oil. So all this oil is trapped in the U.S., which led to a very low price in the U.S., a disconnect with international prices, but nonetheless, obviously, oil imports into the U.S. also substantially declined. Nigeria no longer exports to the U.S., used to be one of their important markets. So these cargoes have to find a home somewhere, and typically, well, people are looking to Asia for picking up that slack. But there's been recently a slowdown in demand. So while demand is kept up reasonably, the increase in demand, the pace of demand has slowed down, but you've had this tremendous increase in oil supply.
Mm-hmm. So what's the role of Saudi Arabia in this, and what's their scope?
Well, people are actually questioning whether OPEC is losing its role. And of course, OPEC is not a homogeneous organization. It has, its members are in various situations. Saudi is definitely the leading company. And Saudi Arabia has always performed the traditional role of the last 30 years or so of being the swing supplier. Which Saudi Arabia is the only country in the world that has excess capacity, production capacity. So when it's necessary to increase production, it's been generally Saudi Arabia that can do that. Obviously here, this is a question of reducing production, and Saudi Arabia has refused to do so, and taking OPEC along with it. So again, rather than protecting the price, they have been trying to defend market share, particularly with their Asian customers, probably particularly meaning with China. Will the role change permanently? And this is an interesting and good question. I don't know the answer to that. But certainly a lot of people are arguing that the shale oil in America is now a new source of swing capacity. One of the interesting factors or characteristics of shale oil is the fields tend to produce much shorter. Typically, they last a year. So there's a lot of drilling. The drilling goes in and out, and so you can change production also quite quickly. And this is sort of a new feature. So it might be that Saudi Arabia is at least not the only swing producer, but might be sharing that role with the shale producers.
So Saudi Arabia really tries to battle down the shale oil producers in the U.S. and
yeah, Saudi Arabia has the great advantage of being the low-cost producer in the world, something around $10 a barrel. The shale producers are among the high-cost producers. Several months ago or a year ago, people were talking about $70 break-even. And by comparison, the highest cost producers is the Canadian oil sands at about $80. However, again, there's a lot of independent producers in the States. The shale oil plays tend to be sort of newer, smaller companies. It's not the oil majors that have been playing in this area. And one of the dynamics is two dynamics. The oil producers in the States have been trying to push down the break-even, and they've been successful. So people are talking perhaps even in the 60s or 50s for the break-even. So that's coming down. So they're able to survive a bit more easily, but they're also driven by the fact that their main source of funding is the U.S. junk bond market. So they have to, there is an incentive to continue production in order to meet their financial obligations on that side. So I think the Saudi calculation is that they can much easier outlast the U.S. shale producers, and they'll be easier to break them. But actually, so far, what's interesting, we're seeing more of a bending rather than an absolute breaking at the moment. Again, because they've been able to lower their break-even costs. So the story's still playing out.
So let us look a little bit into the future. So am I right that the supply and demand side factors, as well as the geopolitical reasons, will all contribute to a lower oil price in the near future?
Yes, I think that's the safer bet. The factors that are coming together, are the continuing shale oil production. Iran could come back into the market if sanctions are further eased, allowing them to come back in. So again, an increase in supply. I think one thing in sort of the longer term, perhaps, is that, of course, the United States is not the only country that has shale oil. In fact, the largest shale oil reserves are in Russia. So they're well blessed with oil. But also, interestingly, Argentina has one of the largest shale oil reserves, as well as China. So there could be that's being tapped into. I wouldn't say that's a near-term thing, but certainly it seems that at this point, and again with the slowing down of the the growth of the emerging markets, the IMF just came out with a bit of a warning about the slowdown in growth. So the factors would seem to tend more towards keeping the oil in a lower band, and I guess we'll have to possibly wait for the next oil shock, and who knows what that will be. Deteriorating situation, as you suggested before, in Russia, perhaps, Russia, Ukraine, who knows, something like that. But at the moment, difficult to see a high oil price environment coming back.
And so what price range are we talking about then?
Oh, always a difficult one to answer. I would say, if I had to, as I was forced to say between this and $80. And would it go much lower? In the long term, oil prices tend to be targeted towards the marginal cost of production. So 70-ish, 80 would perhaps be sort of a limit on that. But again, barring a shock, who knows?
Professor Robert Piller from the Haute Ecole here in Geneva, thank you very much for being here today.
Well, thank you very much for having me.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.